All right, let's connect with Mihir Vora now. Let's talk markets, budget, and how things are looking up in terms of the market mood. Mihir, good morning. Thank you for joining us. Are there any expectations from budget this time?
I think the budget, being an interim budget, should not have major shocks. But it will be interesting to see how they balance the imperative to trim the fiscal deficit to as close to 4.5%, which is the glide path that we have to show, especially given the fact that this is going to be the year in which Indian bonds get introduced to the global bond indices.
She will still have to give a number for FY25.
Yeah, absolutely. So my guess is about 50 basis points reduction in the fiscal deficit will be shown.
So 5.2.
It should go from 5.8, 5.9 to about 5.4, 5.5.
5.3, 5.4 is the general view.
That's the number they should show. Revenue expenditure may not again grow that much, but given the fact that this is an election year, it's going to be a fine balancing line, because for the last couple of years they have not grown revenue, they have kept subsidies under control. But there is rural stress that we can see. On the other hand, CapEx has been doing very well, and we all enjoying the benefits of the big spending CapEx. That probably may be curtailed. Let's see how the balance pans out.
But the tax collections have been very buoyant.
Exactly, yes. And that's the reason why they've been able to spend on CapEx.
True.
But she will have to spell out, or the finance minister will have to spell out a few basic assumptions.
Yes.
Which is your assumption for fiscal deficit for FY25.
Yes.
She will have to give an indication of what the expenditure plan would be, capital expenditure, and what is her assumption for direct and indirect tax collection or revenue collection for FY25.
Absolutely.
Those are important numbers.
Absolutely. And my guess is they'll work with a nominal GDP growth rate about 11-12%.
Okay.
Right. And while direct tax collections have been very healthy this year, indirect tax collections are not that great. So it is basically direct tax collections which have been buoyant. FY25 may not see as much growth in direct tax collection because we are working from a high base. Indirect tax collection should improve. So there again the composition may change. But my guess is it will be 10% growth in most of the expenditure items and the revenue tax collection.
And that is good for market?
That should be good enough for market. I don't think we are expecting too much, frankly.
Okay. But would it have a populist tone? Will the government try and bump up the rural end of the economy, which has been beleaguered?
Yes, absolutely. That's what I was saying. No? They haven't been spending so much on revenue and subsidies in the last couple of years. But this is an election year. So we might see some, for example, the PM Kisan, that's an important scheme. The Pradhan Mantri Awas Yojana may be rolled out for rural people, rural poor also. So those kind of, schemes. It may not be, huge amounts, but directionally and at least from the tone and tenor, you might get to hear some expectations. I think they might do something more on water, because that's again a critical focus area. So those, I think, social schemes may be expanded this year.
And do you think revival of consumption is going to be a key theme, since you're talking about things like rural?
Yes, absolutely. Especially, as I said, it's an election year. Yeah. So they would want to have some feel good there.
So Mihir, if there would be an indication on assumptions, which is direct taxes, indirect taxes, fiscal deficit, capital expenditure, subsidy spend, then it's almost like a full budget. I mean, what else normally comes in a full budget?
Yes,
these are the 4-5 data points.
You may not have major tweaks in the tax structures, or people expecting something on capital gains and stuff like that. That they might leave it for August.
I don't know.
I'm always wishing. I'm always wishing for a reduction in person taxes.
So, really? I mean, somebody's expecting it. Who is this person? How to meet man?
Yeah. So nothing big bang, I guess, in terms of tweaking of taxes.
So what that means for the market? I'm just trying to understand that. Okay, it turns out to be a budget which could be called as a no-harm budget. Everything remains in terms of status quo. What markets are expecting, they get everything. The market has not seen a wild pre-budget rally or a pre-budget sell-off because of any concerns.
Absolutely.
So 1st of Feb, budget gets over. The 2nd of Feb, will it be back to square one?
I think it is. And I think it's a sign of a maturing and matured economy that budget is not a big deal anymore. Look, GST, which is a big component of tax collections, is anyway outside the budget, right? The GST Council decides that. And corporate taxes, direct, and all the other, personal taxes, slabs have been rationalized, and government anyway wants everybody to move to the new regime, which is far more simpler. So there is not much tweaking left in any case. It's not like the old times where you have to wait for import duties on specific items to be changed, and all that gaming of
the system.
So every sector researcher was an adrenaline. But
shoes are expensive, but shoelaces are cheaper.
Yeah, exactly. So excise duty tweaking and all those things are gone. Yeah.
Cigarettes are expensive, but bidis are cheaper. Those days are gone.
And and whatever millimeter, something. But I think, more than the budget now, the positioning of the market is towards the elections. And I think the proof is in the reaction that we had post the state elections.
The markets
and now
already
with
seem to have given the verdict on the elections. Right?
And why not? Because look at what's happening in, say, for instance, with Nitish Kumar over the weekend. It's only making your case stronger that it's going to be a very fragmented opposition.
Absolutely. So markets already discounting, I think, continuity of the regime. And so I think it's back to global economics and our own initiatives on various fronts that we are looking at,
And let's also talk about the positioning of the foreign institutional investors in terms of what the expectation is for the year ahead, election year, budget, etc. Do we think we can lean on support from the FIIs? A small buy figure just yesterday.
I think so, because, there is, as of now, I mean, there was a risk off environment, say, a month ago, but now it's back to risk on globally too. And India is expecting bond fund flows also, so currency hopefully will remain stable. So if you got good tax, good interest rates and a stable currency, then FIIs should come both in equity and fixed income, my guess is. I mean, anecdotally, as you know, I'm building a team, and I can sense that, there are lots of FIIs looking to hire analysts and fund managers, because I'm hiring, so I know who I'm competing with. So there are funds who are coming to set up India desks with 2 or 3 people. So there is definite interest in India, especially given that now we are looking for a India-specific fund regime. Earlier, it used to be global funds or GEM funds, global emerging market funds, who used to invest in India. But now I think it's coming back to India-specific funds also. And I can see that, interest in India for the long term.
But that interest is definitely not coming back to the financials. And I mean, rightly so. The earnings are, proof at that. Be it an HDFC Bank or Bajaj Finance yesterday, wherein the asset quality is marginally deteriorated, the pressure coming in from personal loan slippages.
I think it's a bit of a cyclical issue, and we've seen time and again, banks and NBFCs are the smartest people. They will maintain their margins ultimately. So if not this quarter, next quarter, if not, then quarter after next. So I structurally don't see a squeeze in margins. It's just that the RBI has kept liquidity tighter than what was expected. So to that extent, I think it's more a function of the tactical stance that the bank has taken, the central bank has taken, which is kind of impacting margins. Otherwise, I don't see a structural issue, frankly. If we are talking about 7% GDP growth for FY25, then credit growth has to be 15%, sure. and of course the smaller banks, private sector banks and NBFCs will grow faster. So I don't think that thesis has changed, frankly, except for some pockets, as the RBI has rightly mentioned, in retail loans or unsecured loans, there might be some stress. But as a part of the overall system, it's nothing to worry about.
So long-term money, you're saying, should find a value at these levels after the correction that's played out in
These
private
are some
banks?
of the Indian private sector financials are some of the best managed financials in the world, whether it's in terms of technology or branding or product mix. I think they're pretty much there.
Mihir, but for markets to, let's say, significantly go higher, I'm not talking about like what happened yesterday. That was more like a technical adjustment. Let's say 10% or 15% higher. What could be that trigger? Election verdict already in the price. Budget is almost like a no event. Globally, inflation peak is behind us. So what could really, push markets higher by even 10% from here?
It's, I think, sheer earnings growth. We're expecting 15% earnings growth for FY25. That alone should take the market to, to at least high single digit. And if the consensus veers towards GDP growth of, say, 7+, then probably we can see some more upside if there are upgrades. Otherwise, there are so many sectors which have still not even reached their pre-COVID levels. For example, auto is now reviving, but if you look at the auto unit numbers, they are still only a little above pre-COVID levels. So we really haven't done in a lot of sectors that much. So there is a lot of consumption catch-up to be done, frankly, I would say. Real estate again has started performing now, but there was a long period of underperformance and lack of volume growth. So there's a lot of sectors where we still have steam left.
Yeah. No, I'm just putting the question in reverse. Okay, fair point. Sectors which have not reached pre-COVID, they still have headroom left. Autos, even pharma. But there are a lot of sectors which are way above pre-COVID. PSUs, railways, defense. What happens there now?
See, again, we have to look for IT also. You can say IT also this year. But in each of these, we'll have to look at it sector by sector. IT, for example, I would be a bit cautious. Because relatively speaking, I think the domestics should do better, and as we said, IT is far above the pre-COVID levels, and probably the best of the growth that we've seen in FY22-23 is not going to be seen seen at least for a few years. So IT, I would be a bit cautious. But in terms of defense, railway, etc., these are paradigms which have emerged only in the last 2 years. And it's in a sector which is newly emerging, I would say. And I would say newly because these companies were always there, but the policy has changed. So when you're talking about policy change, you don't even know what the total addressable market is, whether it's only domestic market for replacement and Atmanirbharta, or we are talking about global exports. If you're talking about global exports in these segments, then the TAM can be the total addressable market can be much wider. So right now the stocks are probably running a bit ahead without visibility, but that typically happens in high growth segments.
And what about, given that there's so much optimism about generative AI, etc., and you're looking at online B2C, you're saying that's an important sector?
B2C, I think, again, broad thesis, if you see, is that intangibles, branding, and technology will form a larger and larger part of the market cap. In the US, 40 years ago, 80% of the market cap or EV of the stock market used to come from physical, tangible assets. Now it's the other way around. Intangibles is now 80% of the EV. Similarly, in India, if you look at even the Nifty, for example, financials, IT, pharma, FMCG, this will all be 60+% of the market, right? These are asset-light models. So I think intangibles, network effects, AI, those kind of things will continue to have a bigger and bigger impact on the market. And these are segments which are here to stay. There might be winner takes all kind of a situation where in each of the segments there'll be only one or two players, but that's the way it's going to be.
Yeah. You think energy is the space to be in right now? You're already seeing some of the stock prices reflect that. What with the move on in ONGC, Reliance, etc. Though Reliance is not a pure play energy business at all. But you think that's a space that you need to have as part of your core portfolio? And I would include power as well over here.
Power I would treat separately,
Sure.
but energy I don't like the sector, frankly speaking. I mean, it might look cheap and we might play tactically from time to time, so don't hold me if it's there in the portfolio. But it's not a structural bet, it's a cyclical bet. Sometimes the valuation catch-up game, sometimes it's probably a small momentum play on oil prices. But problem is that it is a heavily regulated sector and margins will be controlled if they go out of whack. So ultimately, you can't give very high valuations to segments where there's good guarantee of government interference from time to time. So I would not value them very, very highly. Power probably is a different segment where we are really facing a shortage, and these are good manufacturing kind of companies. There the growth rate and the path to growth may be a bit longer.
Okay, Mihir, great to have you on the show. In fact, you've given us a lot of food for thought